Welcome to Honey Explains Money, where complex finance becomes simple and every dollar has a story. Let's begin.
Hey everyone, welcome back. If you've ever felt like you're completely drowning in a sea of complex trading patterns, just randomly drawing lines that absolutely refuse to work, well, you're in the right place today. In this explainer, we're going to completely strip away all that indicator noise. We're zeroing in on the 5 concepts behind levels, and we're going to reveal the absolute core mechanics of how market levels actually work. Here's what we're covering today. First, why traders fail. Second, the floor and the ceiling. Third, the 5 concepts behind levels. And finally, trading the reversal zone. Let's get right into it. Section 1. Why traders fail. Look, we've all been there. You draw so many random lines on your charts that the whole thing just ends up looking like a giant bowl of spaghetti, right? But why do most traders fail so consistently? You know the drill. You try a new indicator, then maybe a new pattern, basically just guessing which line is actually going to hold this time. Well, to understand this trap, we first have to uncover who is actually moving the markets. And honestly, it all comes down to this: retail traders versus big institutions. See, as retail traders, our relatively small money executes instantly. We click buy and bam, we get filled in the absolute blink of an eye. But big institutions? We're talking massive hedge funds moving billions of dollars. They literally can't buy it all at once without completely breaking the market. So instead, they leave massive limit orders sitting at specific prices, slowly building literal walls in the market. And that, my friends, is exactly why price bounces. All right, moving to section 2, the floor and the ceiling. So before we really dive into our core concepts today, we have to clearly identify what these institutional walls actually look like in practice. Simply put, support is your floor. That's where you look to buy. And resistance, that's your ceiling, where you strictly look to sell. It's great because it gives you a very simple binary rulebook to keep you perfectly aligned with exactly where the big money is defending its territory. Now, we also really have to watch out for psychological levels. These are just massive round numbers that human psychology naturally gravitates toward, and they cause absolutely huge market reactions. I mean, a number like 6,880 is pretty normal, sure, but a huge round number like 7,000, that is a total psychological magnet. People just naturally place orders around these nice, neat milestones, and the sheer volume of those orders makes it incredibly likely for the market to either break out in an absolute frenzy or reverse really sharply. Okay, on to section 3, the 5 concepts behind levels. So, here's the million-dollar question. How do we actually separate the strong levels from the weak ones? Well, that brings us straight to our main framework. Concept number 1, higher time frames. Listen, you just can't see the big picture on a tiny 1-minute chart. Honestly, it's like standing an inch away from a massive painting. You have absolutely no idea what you're looking at. You absolutely must map your levels on a larger time frame, like a 15-minute chart, to spot those major multi-day turning points. If the big picture doesn't align with your setup, there is no trade, period. Moving right along to concept number 2, extremes. See, institutions step in at the absolute extremes, right where the market is heavily overextended. So, if you're trying to trade in the messy middle of a range, you're honestly just asking to get faked out. I mean, think about it logically for a second. The extremes are where the market is almost painfully stretched. Buyers step in at historic lows, sellers at historic highs. If you're cluttering up your chart with a bunch of lines right in that messy middle, you're trading on levels that simply do not matter to those billion-dollar bankrolls. Concept number 3 is all about validation, multiple touches. Rule of thumb here: never, ever trust a line drawn from just one random swing. Remember those massive institutional limit orders we talked about a minute ago? They can't fill everything all at once. So when price comes back a second time and bounces in that exact same area, that's your proof. You need at least 2 solid taps to confirm that the big money is actually sitting there, actively absorbing all that pressure. All right, concept number 4 focuses on the reaction itself, strong moves. Look, a weak level just sort of slowly drifts, but a strong institutional level, that's going to show a massive, aggressive reversal that leaves absolutely zero doubt in your mind. When price hits a real floor or ceiling, the rejection should be pretty much violent. You want to see big, fast candles moving rapidly away from that area. If it hits a resistance level and immediately flushes down, that completely confirms the level is highly, highly significant. And finally, concept number 5. Honestly, this one is an absolute game changer for your charting. You really have to stop drawing exact, super thin lines. The markets rarely ever bounce at the exact same penny twice. If you're relying on a thin line, you're going to constantly miss entries just because the price missed your line by a single tick. Or even worse, you'll get stopped out because the price slightly pierced it before reversing. It's frustrating. So instead, draw a rectangular zone. Capture the extreme high all the way down to the meat of the reversal. That creates a flexible, forgiving zone where you can actually realistically hunt for your setups. Seriously, feel free to grab a screenshot of this checklist right now. 1. Higher timeframes. 2. Extremes. 3. Multiple touches. 4. Strong moves. And 5. Zones. These are the 5 concepts behind levels that actually matter. If a potential setup doesn't check off these 5 boxes, just protect your capital. Sit it out. All right, final section. Section 4, trading the reversal zone. Let's see how all of this builds into a real-world scenario to help you avoid what I like to call the ultimate trading trap, the failed breakout. See, beginner traders will watch the market barely tick higher and instantly think, oh man, huge bullish momentum. I need to buy right now. But institutions, they actually use that tiny little pop to sell off their massive positions to those super eager retail buyers. They trap them and then aggressively dump the price. Understanding this dynamic is exactly how you stop being the liquidity and start trading alongside the banks. So here is exactly how you trade it. Step 1, you wait for the price to hit a major higher time frame zone, like a massive 7,000 psychological level, for example. Step 2, don't just guess. Drop down to your 1-minute chart. Step 3, wait for the prevailing trend to actually break down, starting to print lower highs and lower lows. And finally, step 4, enter the trade the second it breaks that minor support. You place your stop loss safely above the high, and then you just ride that institutional wave all the way down. When you finally strip away all that clutter and focus strictly on where the big institutions are building their walls, trading transforms. It stops being a guessing game and becomes a predictable business. So I'll leave you with this. The next time you open up your charts, you really have to ask yourself, are you actually trading alongside the big money, or are you just becoming their liquidity?
Thanks for watching Honey Explains Money. Subscribe for more powerful insights on wealth and finance. See you in the next video.